So when we talk about good or bad or neutral, the way that that gets defined is how it compares to expectations. So the expectations set the baseline, and then is the news better, worse, or the same as expectations? It's not based on kind of what you might just consider good news or bad news. It's really based on your expectations. So good news is better than expected. And if that happens, we'd be likely to have an unexpected return that's positive, such that the actual return is greater than the expected return. What does that mean? The good news comes out, we'd expect immediately the price to go up. What about bad news? It's worse than expected, and we'd expect the unexpected return likely would be negative. The actual return would be less than the expected return. We expect the price to go down. And if we have neutral news, we would expect that to lead to an actual return equal to the expected return, because the unexpected return would be zero, and immediately we'd expect the price to remain the same. So this is our response, and again, the key to keep in mind is how it compares to expectations. A quick note that when you're given information about something being announced, what that means is that information that was private is made public. And so the analysis, the discussion that we're having now is really relevant for when a company or the government or someone makes an announcement. So they had information that was private, they knew it before they stepped up to that podium, then it gets announced, it gets made public, and now it's out there. And what kind of response do we anticipate? So the market is semi-strong form efficient. Investors are expecting that firms are going to announce that dividends are going to grow by 5% forever. Firm comes out, says dividends are forecast to grow by 6% forever. That would be considered good news. Why? Not because 6% is inherently good or bad, but because they expected 5 and 6 is higher than 5, and therefore 6 is good news. Even if 6 is a record low, even if every year before that it had always grown 7, 9, 12, 15, they come out and say 6, it's not, oh, it's terrible news, that's worse than ever before. They say that's better news because we expected 5. And we would expect a positive, unexpected return, and immediately we'd expect the stock price to increase. What if the firm comes out and says dividends are going to grow by 4% forever? Even if 4% is a record high, even if the firm in the past has always had, flat dividends or decreased them or increased by 2% or 1%. So 4% forever is considered, it is higher than historic. It's still bad news because they expected 5 and they're only getting 4. Therefore, we'd expect, or we would anticipate, that the unexpected return would be negative, and immediately after the announcement, the stock price would go down. If the firm comes out and says 5% forever, that's what was expected, so there's nothing that's actually unexpected, the unexpected return would likely be zero, and the price right after the announcement would stay the same. So again, just to go back up here, when it came out at 6, we expected 5, so what was unexpected was 1% over. Here, when it came out at 4, what was unexpected was that it was 1 percentage point under 5%. So here's a question. Markets are semi-strong form efficient. At 10 this morning, investors expected Carmichael Federal, that they were going to announce that dividends would be lower, that those dividends would be 50 cents per share, and not only that, after that, they'd shrink by 2% a year. Next dividend due in a year. 10:01, so right afterwards, they come out and said dividends are going to be 60 cents, and that's lower, worse than the dividends have ever been for that company. And then not only that, they're going to continue to go down. So every year is going to be worse than the year before. They're going to climb by 1% a year. Explain why you think A, B, C, or D is true. Do you think that for what happened immediately after the announcement, and assume risk isn't going to change, nothing else was announced, just the effect of the announcement? Do you think the price of the stock likely went up, down, stayed the same, or it's not clear? What do you guys think the answer is? The answer is A. The stock likely increased. And why would that be? Because we need to compare the news to what was expected. So again, markets were semi-strong, so they reflect all publicly available information. The announcement added to the stock of publicly available information, and the announcement had good news. Dividends were going to be higher than what they expected, and the growth rate of -1 is better than -2, and so the growth rate was also good news. Two pieces of good news. So, again, remember that, here we have a constantly growing stock, so the price is D1 over R minus G. If D1 goes up and G goes down, they both have effects of increasing stock prices. So we would expect that this is good news and that immediately the price of the stock would increase. So, real quickly, if markets are efficient, then the returns would reflect complete and accurate responses to new unexpected information. That's what we've talked about. But what if markets are not efficient? Then it's reasonable to assume that prices and returns would be influenced by new and unexpected information. And the way we're going to cover unexpected returns, the way we're going to address this in this section, is going to be relevant for markets that are efficient, which we've talked about, as well as markets that are not. It's less clear exactly what the response would be if markets are not efficient, but it's reasonable to assume that when new unexpected information comes out, there's going to be a response that's going to be consistent with whether that new information is good or bad based on what the news is relative to expectations.